Well, hi ladies and gentlemen. Welcome to FSMOne, Where and Where to Invest 2024. My name is Kevin here and nice to meet you guys. Today I'm going to present the key investment themes like what Mr. Koh has mentioned just now. Where should you invest and how should you invest in 2024? Before I start my presentation, this is just a disclaimer where all investment decisions should be made after you have assessed your own risk appetite. And if you have any advisors, please seek advice from them before you make any investment decision. Okay, so coming into the 2023, what has happened last year? If you look at on your left-hand side, you can see most of the markets are showing a positive performance, particularly developed markets. Technology, Latin America, US, World, Japan, Malaysia, not Malaysia, even Asia ex-Japan, all these markets, they generated a positive performance last year. Why? Because of more clarification from the Fed's monetary policies. And in the year of 2022, people are starting to worry about, because of the inflation, the Fed, they started to hike the interest rate aggressively. So that's why in the year of 2022, probably it's not a really good market. But coming to the 2023, most of these developed markets that has already experienced the slump in 2022, they experienced a strong rebound in 2023. So that's why you can see most of the markets, they're showing a positive performance here. Unfortunately, China market, because of the looming recession fear, the property, the regulatory crackdown, all these uncertainties are still haunting the market. So what are we going ahead in the year of 2024? From the bond market, well, you can see that both sort of bond market, they also experienced a positive performance. So, but what I want to highlight here is currency. Malaysia against US dollar. Probably you're all already aware that Malaysia ringgit in the 2023 is not a really good year. We have depreciated against the US dollar. Why? Because the Fed, they have raised their interest rate. As of yesterday, is 5.5%. While our Bank Negara Malaysia, they hold our overnight policy rate at 3%, meaning that the interest rate parity, or in a simple way to illustrate, the interest rate differential between US and Malaysia is starting to be widened. So that's why it's the main reason of Malaysian ringgit to depreciate against US dollar. Well, also I would like to take this opportunity to show you what is our report card in 2023. Well, we do hit a 62% of hit rate of key investment teams in the 2023. So what I want to highlight here, for the first one, a global recession is likely unavoidable. Well, like what I have stated just now, in the year of 2022, a lot of people, they are worried about, because of the soaring interest rate, it will hit our economy. But what has, on a high side basis, we already know that because of the resiliency of a US economy, during a COVID era, people are locked inside their own houses. And even at the same time, the government is injecting a lot of money into the economy. So that's why we do have the excess saving to provide a cushion for the soaring interest rate. So in terms of a global GDP-wise, we do see a positive performance, and we do not see a recession in the year of 2023. Next, we do see that interest rate is going to be higher for longer, meaning that we do think the 2% inflation target is not that easily achievable in 2023. Hence, the Fed, they will tend to maintain or even hike the interest rate. At least as of yesterday, it's reached about 5.5%. So coming into the 2024, what is our view towards the interest rate? So these are our key investment teams. I have separated it into three sections. The first, macro. From the macro perspective, we still believe that the central banks, even after what happened in 2023, in the year of 2024, the central banks will still struggle to tame inflation, meaning that interest rate will continue to be higher for longer. Next, the brighter prospects for global economies. Although our assumption that interest rate is going to continue maintain at current level, or even we are at the end of terminal rate, we still believe that there are still plenty of places or regions for you to invest in. That's why some of the regions that we like, US, Malaysia, Brazil, even some new terms that I am going to introduce later, new Asian tigers. Third, from a currency perspective, because we believe that we're at the end of the terminal rate of the US monetary policy. So we are hold neutral on the US dollar. In the year of 2024, we believe that we are going to witness a semiconductor upcycle. So that's why Japanese yen and Korean won is our favorite in terms of currencies. Back to our home, Malaysian ringgit, we still hold a positive view on Malaysian ringgit. Next, in terms of investment implication on fixed income, for the global bonds, we believe that the short duration has a lucrative yield for you to consider in. And if you want to invest in global bond, possibly investment grade is a viable option for you. Malaysia bonds, the title is pretty simple, a place you should never ignore. When it comes to constructing a portfolio, we believe that Malaysia bond is always providing a good option for you. Last but not least, turning positive into equities. When everyone is mentioning, we always have two options. You have growth, you have value. Now, we are going to introduce to you quality. That's why one of our key investment teams focus on high quality companies. Next, new Asian tigers. If you want to invest in Asia, but you are worried about some of the uncertainties, especially last year is not. We have a lot of uncertainties on Asia. So that's why in Asia we have three countries for you: Korea, Singapore, and Japan. These are the three new Asian tigers. Malaysia equities. We believe that this year will be a good year for Malaysia equities because of a subsided political uncertainties and also more clarity in our fiscal policies. Next, the earnings recession in digital economy is over. Although we do not experience a recession in terms of GDP, but in terms of earnings, we have witnessed some weaknesses in the technology sectors. That's why we think that earnings recession in the digital economy is over. And last, semiconductor demand to boost by the artificial intelligence. So this will be our first key investment themes where the central banks will struggle to tame inflation. As you can see from the chart, you will notice that actually the inflation, although is showing a softening trend throughout the past 1 year, but in fact, we are still far from the 2% inflation target. Will we hit the inflation target by this year? I believe that it's very tough for everyone to forecast this. But what we can conclude at this juncture is we believe that the Fed, they're going to be data dependent moving ahead. And what's next? They're going to be very cautious in determining their monetary policy. So that's why probably the market forecast of 6 rate cuts is quite overly optimistic. But what can we conclude? It's not a very bad news. I mean, the silver lining here we are already approaching the terminal rate. So that's why our investment decision should made based on the terminal rate of the terminal rate assumption. So next, the brighter prospects for selected economy. As you can see on your left-hand side, these are the regions that we like. Brazil, because of elevated commodity prices. Taiwan, Japan, Korea, Singapore, Malaysia. These are the regions that could benefit from a semiconductor upcycle. So what I want to highlight here is US. You know, US, although the Fed has raised their interest rates so aggressively in the year of 2023, but US economy, in terms of the labor market, we are still seeing a very strong data. No matter you're looking from the perspective of non-farm payroll, ADP employment, unemployment rate, all these data, they are still showing that US is having a solid labor market. So coming into the year of 2024, we believe that the labor market will cushion the impact from the interest rate. So that's why US economy is one of our favorite markets. Next, China and Europe. From China perspective, the regulatory crackdown and also the confidence crush because of a property issue, we believe that China is facing a structural issue here. And that's why, at least in the year of 2023, we hold a slight cautious view on China. Don't get me wrong, I'm not saying that China is totally uninvestable. In terms of portfolio, I would encourage you to include China. But in terms of absolute weightage, we still suggest you to hold a cautious view on China. On a Europe perspective, although US, we can see that the inflation is showing a downtrend, but in fact, Europe inflation is still very, very stubborn. So that's why, in terms of monetary policy, we still don't see clarity from the ECB perspective. Next, the Japanese yen and Korean won, which both countries are very positive correlated with the semiconductor exports. So given our assumption that semiconductor exports will experience an upcycle in the year of 2024, we hold a positive view for these two countries. US dollar, like what I mentioned, we are already approaching the end of, we are already approaching the terminal rate. So that's why we hold a neutral view on the US dollar. Malaysia ringgit is quite an interesting currency because last year we are one of the worst performing currencies compared among our peers. So coming to this year, with a better clarity in the political landscape, with the continuous positive sign in terms of our balance of payment, and with better clarification from fiscal policies and monetary policies, we believe that Malaysia ringgit we hold a slightly positive view on the Malaysia ringgit. In terms of fixed income, what I show you here is Treasury yield. So Treasury yield, what is it representing? So basically, US Treasury, I will claim it as, I will illustrate it as one of the safest assets in the world. If you look at the blue color line chart, you can see that 2 years, meaning that you invest in US Treasury for 2 years, you are able to generate a 4.25% of yield, or I will speak in a simple way, 4.25% of return. Even if you invest it in the 10 years, meaning that you only can achieve 3.88%, meaning that you are getting more return, even you invest in a shorter duration. So that's why we are in the inverted yield curve environment. Short duration is a viable option for you. What we have experienced in the past 5 years, if you look at the gray color dotted line, you will see that in the past 5 years, if you invest in a shorter duration, it gives you about 2.5%. And when you want to take more risk, meaning that you invest in a longer duration, they give you more return, about 2.7%. So coming to today, we are already at the completely different era. What we are experiencing now, inverted yield curve. So that's why short duration will be a viable option for you. Next, investment grade. Taking a step forward, if you manage to handle the risk, if you assess the risk, taking a step forward, investment grade companies usually are referring to those companies that have a solid, strong cash flow, a solid balance sheet, those who are dominant companies. So these companies, they can withstand with the uncertainties. Well, during this era, because of a elevated financing rate, it will be struggle for all the small companies, the high yield, the junk grade bonds. It will be quite struggle for them to finance the rate. So that's why for global bonds, we suggest investors to stick to short duration and investment grade. Well, Malaysia bond. What is showing here is the Malaysia bonds performance in the past 10 years. You can see that throughout the past 10 years, no matter from absolute perspective or relative perspective, since 2014 to 2023, Malaysia bond consistently showing their resiliency. I would like to highlight is the bad year for bond, 2022. You can see that despite the global bonds is showing you a double-digit negative performance, in fact, Malaysia bonds still able to deliver a positive performance in a year. Coming to a 2023, when most of the bond markets, they have rebounded from the previous slump, Malaysia bonds they can outperform the global bonds. So that's why in terms of portfolio perspective, Malaysia bonds is always, like what I mentioned in the title, a place you should never ignore. Coming to equities, when in the past, when we speak about equities, you have two options. You have value, you have growth. What is value? Value is like you are driving an SUV. It's slow and steady. What is growth? It's like you are driving a sport car. It's fast, but it brings you some risk as well. So what we want to introduce you, quality, meaning that you are driving a SUV, but with sport car engine. So the quality companies, in terms of the technical terms, meaning that those companies will have strong balance sheet, solid cash flow, and dominance in their particular industries. You can see that throughout the past 10 years, the red color line representing the quality index. So actually, it can provide you a similar trend compared to the growth index. But at the same time, if you can see from the table, it provides you more resiliency, meaning that you are able to generate a better return with a lower risk. So next, a top picks for Asian equities, new Asian tigers. We have 3 regions here: Japan, Korea, and Singapore. What is our criteria when we come to selecting all these countries? These are the 5 criteria. So what I want to highlight here, when we speak about these countries, some of the brands that we can think of: Japan, Honda, Toshiba; Korea, Samsung; Singapore Airlines, DBS, UOB. So all these brands are the world-class brands, and all these companies, they're already dominant in their respective industries. And at the same time, when the global, especially what we have witnessed in the year of 2022, in the year of 2023, the escalating geopolitical tension has caused a lot of companies to rethink about to relocate their supply chain. So where are you going to switch if they don't want to invest in China, or if they want to switch their supply chain from China or US? These regions, because of the infrastructure, because of the supportive policies, these countries are the best option for the multinational companies. So that's why if you want to invest in Asian equities, new Asian tigers. Malaysian equities is a very interesting market. Well, if you look at the chart on your left-hand side, you can see that Malaysian equities throughout the past 10 years, at least at this juncture, in terms of valuation, we are at a very, very cheap level. So what is the main reason of causing this? Mainly is because of, in the past 4 to 5 years, we have experienced a lot of soup drama in terms of a politic landscape. Coming to the year of 2024, at least after what we have experienced in the 6th election, we have seen more clarity, no matter from fiscal policies or even from the monetary policies. We can see that the Bank Negara, they tend to hold their OPR at 3%. So what we have heard of our Prime Minister, what we have heard from the announcement from our Prime Minister, Anwar Ibrahim, he has mentioned during an economy Madani, you can see that the NETR, NIMP, all these economy blueprint, they cited the terms, which is a economy transition. Meaning that if you want to invest in Malaysia, we think that it's a good time. It's a good time now, and focus on the high growth, high value sectors, or even the domestic driven sectors like construction, property, infrastructure, all these sectors. So that's why in terms of investing in Malaysia, a bottom-up strategy is still preferred. Well, if you look at all these news on your left-hand side, in the end of 2022 or in the start of 2023, people are arguing that recession is going to hit us. But like what I showed you in the first few slides, in terms of GDP, yes, we are still standing happily now. We are not hit by a recession badly. But in terms of earnings, if you look at the US companies, especially the Q1 earnings, you can see that in terms of earnings, they already been hit by recession. We have witnessed the technology sectors, the banking sectors, they did a lot of layoff activities because they want to save their costs. But coming to the year of 2024, we believe that all these sectors that already undergone a recession, they are going to ride on a tide of a path to recovery. So that's why technology sectors is one of our favorite in the year of 2024. Next, the semiconductor to rebound strongly. Actually, one of the main reasons of causing the rally in 2023 is the AI rally. Is AI a new word for us? In fact, it is not. In the past 10 years, we already have the analytical AI, where the companies, they use AI, they leverage on the AI to make their operation more efficiency. Coming to the year of 2024, what's news about AI? The answer, generative AI. I'm pretty sure that a lot of you understand how powerful is the ChatGPT. ChatGPT is one of the most iconic in terms of the generative AI. So that's why we are, in terms of valuation, in terms of a historical valuation, yes, we are at a relative expensive level. But looking at the CAPEX, we are still at a very low level. Currently, we are at this level. So anyone can imagine that what is going to happen in the next 10 years. According to Bloomberg, generative AI is going to be disruptive to our life. So that's why, in terms of implementing all this infrastructure, you need to have computing power. So where is the computing power to come from? Semiconductor. So that's why year of 2024, or even in the next few years, we believe that it will be a good timing for you to have a look on the semiconductor play. So yeah, that's all from my key investment teams. But I would like to take this opportunity as well to tell you, to break a myth that actually active management is still relevant. Well, if you look at how you read this chart, basically you can see that if the bar chart is showing you above 0%, meaning that the recommended fund is beating the benchmark. So in fact, in some of the regions or countries that don't have their news flow is not that efficient, fund managers, they still have the ability or the opportunities to beat the indices. And even in the US market, when the US market experienced a positive a rally last year, you can see that the fund managers, they are still able to beat the indices. So that's why when it comes to investment, when it comes to portfolio construction, active management is still relevant. So I would like to take, it's a key takeaways from me, which is key investment teams. The first, central bank will continue to struggle to tame inflation. Second, some of the regions that we like. Third, we are holding a neutral view on the US dollar, Japanese yen and Korean won to outperform, Malaysian ringgit with slight positive view. Fixed income wise, global bonds, we encourage investors stick to short duration and investment grade. And also, don't overlook Malaysia bonds because it provides a resiliency to your portfolio. Last but not least, we hold a positive view to equities in the year of 2024. Where should we invest? High quality companies. And technology sectors, no matter it's digital or even semiconductor, we hold a favorite view on it. And if you want to invest in Asian, new Asian tigers, Korea, Japan, and Singapore. And also Malaysia equities, it's a good time for you to regain focus. So that's pretty much from my presentation. If you want to know more, visit to our website and you can feel free to read our article. That's all from me. Thank you.